You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Mark Longo here from the Options Insider, and I'm breaking into your regularly scheduled program to let you know about a group and an event that I think may interest a lot of you. I know a lot of our readers and our listeners out there are interested in using and applying their options and risk management expertise in a lot of interesting new areas. And maybe you want to become a fund manager or an asset manager. Maybe you want to create a financial technology startup or become an educator. There's a lot of interesting ways you can apply that expertise. And if that sounds like you, well, then I have a group you may be interested in joining. It's called the Options Alliance. We're a group of active financial entrepreneurs and startups. We have a conference every year that explores all of the issues that are important to new startups and new endeavors in this space, including how to market your new venture, how to grow your AUM. Of course, it's a very important metric if you are an asset manager, and perhaps most importantly, how to fund all of those great new endeavors. It's a really unique event. There's nothing else like it out there. So if that sounds like something that might interest you, then clear your calendar for Monday, December 8th, and join us at the Arditi Center for Risk Management right here in Chicago. You can review the full agenda and reserve your seat at www.optionsalliance.org. And now I'll return you to your regularly scheduled program.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-expanding, ever-exciting Options Insider Radio Network. 13 plus programs ready for your listening pleasure on said network. You can find them wherever you find this program, including the mothership, theoptionsinsider.com. If you haven't been there in a while, I encourage you, surf on over. I think you'll like what you find. We made some fun visual tweaks, some layout tweaks, some design tweaks to the site, more coming. And of course, you have all your great educational, analytical, breaking news on the options market, unusual activity, all sorts of fun content going up there every day. In addition to all of the fun radio programs we put up all the time. Of course, you can also find the radio programs, iTunes, Stitcher, AHA Mobile, all those destinations, SoundCloud even. Paste the RSS feed into your podcatcher or make it easy on yourself. Just go download our mobile app and you can listen to all the programs. You can build your own playlists. And while you're following along with the show, you can shoot off a question via Facebook or email or Twitter or whatever floats your boat and say, hey, I have a question about this, or I disagree vehemently with that, or whatever the case may be. We love to hear from you guys. All right, and joining me on the old Volatility Views panel today is the one, the only, starting off with the man. Actually, one more time. I said is. I should say are. I should remember my tenses from first grade grammar. One more time. All right, and joining me on the old program today, our first up, we have the man beaming in from the hot and heavy action in the middle of the maelstrom that is BGC Partners, none other than Mr. Jared Woodard, their research major domo over there. Mr. Jared, welcome back to the show, sir.
Thanks. It's great to be with you.
And also beaming in from the East Coast, but a little bit farther east and a little bit farther north from the deep Pictish wilderness known as Maine. You know him, you love him, as our unusual activity editor extraordinaire / major domo over there at the pit, Mr. Andrew Giovinazzi. Andrew, welcome back to the program, sir.
It's a pleasure to be back after being flued out last week.
Yeah, you had a double whammy. First the weather, and then the disease god struck you down.
I was taken out and laid low, but I'm back. Good or bad that is.
Indeed. I'm sure our listeners are very happy to have you back on board. Because last week it was just me and Jared. And, Jared, he's sitting on the fence all the time, and I'm making these outlandish statements, and it's just all kinds of crazy. Here you're kind of a good middle ground one. You can push us in one direction or the other.
I try to do that. I try to push you both around to the extent possible.
All right. I think it's time for some pushing around because it's time to dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
It's always a dangerous little transition to play because I end up dancing here in our little studio while I'm waiting for it to finish up. Then I get completely distracted as to what we're actually doing here on the old program. Of course, this is indeed the portion of the show where we break down the interesting activity of the week that was from a volatility trading and analysis perspective. We are recording this today, listeners, Friday, November 21st. I'm look at the right clock for the right date this time. And it is another day where the markets are having a bit of a mild rally, but guess what? So is implied vol. Most of the major indices up about nearly 0.5% or so. Q is a bit of a laggard, up about 0.25%. And VIX Cash ticking up a wee bit as well, which, as you know, underlying ticking up. Going into a long weekend, VIX Cash not selling off means we're getting a little bit of some juice in the old implied volatility land. Before we dive into the show, I do want to kick it off and say, hey, I was at the Global Derivatives event here in Chicago this week. I had the privilege of chairing one of their sessions earlier this week, and it was also being on a volatility buying panel, ironically. So, Don, don't listen to that one. You would have been deeply offended. And the reason I bring that up is because I love going to these events because so many people come up to me during the course of these events and say, hey, I love this episode. I listen to the show all the time. So a lot of our listeners were there. Also, a lot of our who's who of our former guests were there. So we had Scott from Russell. I ran into you and Sinclair while I was there. A number of other guys were floating around at that conference who've been on the program. So it's very much like a Volatility Views reunion. And whenever I get a chance to meet up with the listeners, I really love that because that gives me a lot of great feedback. People from all over the world, Copenhagen and others who were big fans of Volatility Views. So that's always fun to hear. And also a little bit intimidating because when you put faces to the myriad of names and voices out there, people are actually listening to this program. And it's always a mystery to me. But we love it. We appreciate all you guys do in terms of sending in questions and comments. And so I love to meet you guys and interact whenever possible. So maybe I'll see one of you guys at a conference coming up soon. I did tweet out some interesting stuff about implied versus realized and risk premium, and I actually retweeted something from you and Sinclair that a lot of people were vehemently opposed to. I think we'll get into that a little bit. I think there's a listener question about that a little bit later. So we'll get into all that fun stuff in a few minutes. But from terms of a pure volatility perspective, and as I mentioned, that actually VIX Cash just ticked down, so much for that premium going on today. But it has been, in terms of a starting off point in VIX Cash land, hasn't been the most active, the most market moving of weeks, certainly not compared to last month when we were gapping all over the place. We saw pretty much a range of about 2.5 handles in the VIX Cash for the better part of the week, a high of nearly 16, about 15.75, and then a low of right around the 13 handle, 13.13, I believe. So bit of a relatively modest range, certainly compared to recent history at least. And we're seeing, of course, the realized vol coming in commensurately as well. We got to that peak of 20 on the 10-day realized back in the heat of the fury of October, has come off to the 4 to 6% range, depending on where you look, which day you look, most days these days. So certainly an aggressive coming in of realized volatility as well. Mr. Jared, perhaps we'll start with you. Amidst all of the maelstrom of activity going on over there that is diverting your attention, what has caught your eye in this week from a volatility perspective?
One thing I noticed is that you haven't seen the kind of reaction in options markets to strength in stocks and economic data overall. There's been a bid, I think, for premium, especially this week with VIX almost unchanged from when we had this same conversation, a week ago, despite just broad positives and a real lack of meaningful volatility on some sessions. So I think it reflects a demand for some option premium. If you think back to the mid-October sell-off, we saw stock indexes around the world at levels of implied vol that we hadn't seen in a long time. Looking back over some of those ranked levels now, almost everything has come back to earth. The only exception probably being Japan, which has relatively rich premiums now for some very specific idiosyncratic reasons.
I wonder what those could be, sir. Why would anyone give any premium to Japan right now? What's going on over there?
They're getting ready to fight a war with China, of course.
Oh, yes. Yes. I forgot about that. The impending invasion coming from the Japanese fleet. I think we'll move on from that really quickly, lest we spark some outrage or concern from our Eastern listeners. Speaking of the East, not that far east, but all the way up in the hinterlands of the Northeast, Mr. Rock Lobster, I know you've been busy doing a myriad different things this week. But in addition to that, what's caught your eye? What's been the gist of the vol discussion over there in the pit chat? And what are your clients watching? What's essentially been your gist of the week that was from a volatility perspective?
From a couple things, like Jared said, I thought, with the market pretty much rallying all week. Here we are, another all-time high. Tucson, I guess, I don't know if how many times can he keep saying that? It's never been a better time to sell the S&P 500.
About once a week at this point.
He's going to be saying that for a long time. And the public, as long as the public, I guess, still thinks we're in a recession and everything like that, they won't be buying stocks anytime soon. But we just watch the markets rally, and that's okay with us. What I'm thinking of just in general is vol kept catching a bid. We couldn't quite see the lows that, we were expecting from market all-time highs, which to me always means a lack of willing sellers. I've been kind of beating that drum all week. And to be honest, I think it's hard to sell premium in this market. Like a 13% vol, you still have these 1% days, or we're stringing along these rallies. And as an old SPX trader, I remember, that's what pulled the curve up and got everybody all bent over backwards, because all of a sudden nobody sold juice anymore. And I think that's kind of what's happening right now. We're stretching so far, so fast. There's no time for premium to really, let's just call it reset or contract. And the out-of-the-money volatility keeps getting dragged up, essentially, or the at-the-money vol. And we're not, I guess the curve is sort of adjusting upward instead of sort of staying sticky to the strike like it normally does. So I think I don't know if everybody was ready for the market to continue to rally like it is. But as of right now, it just keeps doing it. And I think, we thought we'd see some lows for vol, and I just think there's too much realized vol overall for that. I know you had that quote. I don't know if you wanted to talk about it now or when we talk about it later, but I think the big distinction, which of course will be my doing stuff book. Well, there's just people do not understand realized volatility. It's the bottom line. They understand the VIX. Well, actually, they don't even understand the VIX. They know that it exists, but they don't understand realized vol. And I think understanding that gives you much better edge in the marketplace overall. And I think right now it is, let's just call it, even though realized vol is 3%, it feels like it's trading much higher in a lot of name equities. So sometimes that unidirectional, when the market moves just in one direction, volatility actually plays higher than it actually is, than it's showing as a number. And I think that's kind of where we are right now. It's just we're in a place where that one direction really makes it tough to trade, tough to price volatility. And that's essentially where we are.
No, I had a similar thought. I was looking around actually while you talked because I was mentioning realized vol being in that 4 to 6% roughly range, which is probably about where it feels to me. When I pulled it up today, you're right. Just a minute ago, I was like, wow, you're right. It is actually 3% right now in the S&P. Of course, this is 10-day realized, listeners. We get out to 30 days. It's still got some of that October premium built into it, so it's about a 12. But still, you're right. It doesn't feel like a 3 realized vol right now. It certainly feels a lot higher, particularly in a lot of the products that we watch on a regular basis. That seems like things are moving around perhaps a little bit more. That some of that, of course, being your frame of reference, realized vol, a bit of a subjective thing sometimes, depending on what you're looking at. But it is interesting to see that it is right at that bottom of that range. And we'll get into that, what we were debating on Twitter, perhaps a little bit later. Interesting stuff. A lot of people taking opposite sides of that debate, which, again, that's why there's a market, and that's why there's money to be made out there, as someone mentioned to me at the conference this week. So I think with that, we'll dive right into what we're seeing from an overall volatility options perspective. Let's kick it off with the dedicated vol products, indeed the VIX options products. It was another week of, well, let's say, I guess you can call them decent vol level. Certainly not putting up the numbers we once were. I mean, there were some days this week of 300 some odd thousand contracts out in VIX options land. So those are certainly a far cry, nearly 1 million contracts shy of some of those really, really heady days we saw in October. Again, another day this week, 2 days this week of 300,000 contracts. That's fairly low. That's you can tell we're getting into a holiday week at this point. Even they're cutting it pretty dry and pretty close, even well before the holiday, a week before the holiday. We did have a little bit of 630,000 contracts on, I believe, a Wednesday, but that was probably, or maybe Tuesday, but that was pretty much it from a active day. Let's see how we're looking today. Yeah, today, so far, 320,000, so we've already beat 2 of the days of the week so far from a volume perspective. So people are trading it up a little bit today, but overall, VIX is not really where the action has been of late. Moving on to what we're seeing. Of course, some of those NOV options we talked about a lot that have been dominating the discussion of late, like the NOV 20s, those are now finally gone. So the Jan gets to take center space and top of the list here on our top hot strikes for the VIX options this week. Number one being the Jan 20 calls, 231,000 open. The Jan 20 calls. That shows you, though, just how much of a jump, or a drop, I should say, in open interest there has been in the number one position between last week and this week. I think last week the NOVs were about, I think, between 320 to 360, somewhere in that range. So over 100,000 contracts dropping off here to the number one spot. So, and the number two pretty much equidistant here. The D's 13 puts keeping their level alive. 231,000 open out there as well. So a virtual dead heat for the number one, number two spot. Then moving out pretty much to call land again, D's 25s and D's 20s, about 170,000 open of each. Then number 5, the D's 14 puts. So some more put love coming into the list. This is perhaps a little bit surprising to some people, with about 155,000 contracts open there. And then the D's 18s and the D's 23s with 135,000 and 130,000 open respectively. Then moving on to some more puts. The D's 15 puts on the number 8 spot for about 112,000 contracts. Number 9, D's 19s for about 100,000, and the D's 17 calls rounding out the top 10 again with about 100,000 contracts or so. Only 4.34 million contracts open right now in VIX land, so you could see a lot of premium, a lot of open interest having gone the way of the dodo in NOV, yet to be replaced. So perhaps that's showing you something as well. It looks like a couple million contracts came off there. So perhaps people not having the expectations of a lot of volatility, at least in the very near term, certainly not feeling the need to express it using the VIX options, at least not right now. So everyone kind of playing wait and see, maybe going through the holidays, and then we'll see if they reposition, add on some more hedges, or perhaps some more speculative positions going into the end of the year. Usually, if all things are equal to previous years, end of the year not exactly a hot time for vol trading either. So this might be the par for the course for the rest of the year. We're relatively low open interest, relatively low activity in VIX. We'll see if that holds course. All right, and Mr. Jared, I know you've been quite busy over there in the land of BGC. We can just hear it in the cacophony surrounding you. But I know a few trades probably came across the BGC desk that you noticed going up that may have caught your eye out there in VIX land. So anything really catch your eye this week?
Yeah, there was a on the one, if you look at a 1 minute chart of VIX on Thursday this week, there are two intraday spikes that quickly reversed course And there was a little bit of discussion about this around the internets. And so I looked into this, what was if there was a cause or anything, if it was an error. One friend mentioned that maybe it had to do with the weekly options that have been included now. But if you look at the chart of the old school monthly series, VIXMO, I could see the same little spikes intraday on Thursday there as well. Didn't see any big trades that went up over that time that would have explained the movement. Although there were, in terms of the quotes for options at some strikes, the implied vol, if you take the offer quotes, did spike up, and so I think that probably explains what was happening there. Is that you had some real significant widening of quotes intraday, and it's probably nothing. Probably just somebody had to reset their box or step away for a minute, or whatever the reasoning is. The quotes definitely widened out. I think at 10 o'clock Eastern on the Thursday. It does raise some questions though that people have been asking this year about illusory liquidity, how deep markets really are. Even though everything's functioning great, I think that whenever we get the next big market sell-off, people have some real worries that I think may be pretty legitimate. I mean, you can be concerned about the real depth in the market without going all zero hedge on people. And just as we saw in the Treasury market in mid-October, there are times where things get kind of dicey, and some folks just shut off their market making boxes, and so I think it's something to be aware of. We haven't seen that kind of thing happen in the options market yet lately, but that move on Thursday, I think, got some people's attention, and is definitely something to be watching.
I'm just going to say, I bet you were floating around zero hedge when you first heard about this little blip here. That seems like the kind of thing they would seize on, perhaps with some, shall we say, more outlandish speculative theories as to the cause.
It's kind of a problem, I think, in that not just them, but anybody who looks for bubbles or it gets bearish or looks for risk issues. Over the last 5 years, there have been so many false positives on their end that nowadays, anytime someone does flag something as potentially problematic, I think, at least for me personally, the default is to assume that they're hyping something up just for the sake of the page view or for the sake of attention. And I think it's a crying wolf kind of situation that it is difficult because risks are real and something's going to bite eventually. So it requires a lot of I think careful attention that it's hard to navigate. Not being too sanguine on the one end and not being scared all the time on the other, and some real prudence is necessary, and it's hard to do. Well,
Jared, since you set it up so nicely, I was going to toss to it later, but it is a time. You mentioned Crying Wolf. That is indeed the title of your big report coming out of BGC last week as well. You kind of alluded to it a little bit on the show last week. I know you're limited in what you can say right away on some of those reports because they're going out to your clients first, but now we can really sink our teeth into a little bit. And what we were talking about last week was, of course, how people were talking about the alarmists out there and people who react perhaps zealously, sometimes not, perhaps appropriately, sometimes not, to what they're seeing out there. But a lot of people were getting, shall we say, a bit up in arms about some of the positions that were starting to amass in a lot of those volatility ETPs. These are, of course, the exchange-traded products out there that we've talked about many times on this show, listeners, the VXY, the TVIXs, all those kind of crazy things, all those things that are constructed around volatility that can trade on an exchange-type product. Many of them levered, and a lot of people, we've discussed this on the show many times as well, have discussed the impact of this growing universe of these products and how much Vega is going up in them, how much volume is going up in them, and how if some of that is starting to feed back into the mother products, the VIX and indeed the SPX, and if the tail is indeed wagging the dog. And Jared, a lot of people were starting to look at some of the positions that were amassing, particularly in some one-sided bets on some of these volatility ETPs, and starting to wonder if we were seeing a setup for that exact type of scenario. And you, being the cooler head amongst the people out there, decided to try to allay some of those concerns. So why don't you go ahead and run through some of your findings for a lot of our listeners who probably didn't have access to that report initially, but I think would still be very interested in hearing about your findings.
Oh, thanks. You've set it up really well. I mean, the concern is that I think that the best version, it's always good to argue against the best version of your opponent, and I think the best version of this argument is that the level of information among some investors, the investors who are at this point short volatility, whether they're short VXX or long XIV or have other positions that get them to be net short volatility in these VIX-linked products. The argument is that the flows that are so large in some of these products now represent quote-unquote uninformed or less informed investors, and that because of that fact, when there is some kind of a market move, adverse market move, the people in those positions are going to be relatively weak hands. Are going to be more likely to reverse course. They may incur larger losses than they expected, and so create a kind of a negative feedback loop that adds to any big sell-off. A related concern that I've heard addressed is that because these VIX notes are connected to the very front end of the VIX curve, that causes implied vol in the market to become artificially low, especially relative to medium or longer term. And so that, again, the idea that you're going to have so much contango in the marketplace that it makes any eventual sell-off or any backwardation in the curve even more fierce and steep and costly than it would have been otherwise. So that's the worry. I wanted to get into the data, and rather than come up with theories, more speculation, I wanted to see what the data would show. So we calculated VIX, the Vega notional value in these exchange-traded ETPs, and included the short interest, which is something that a lot of analysts I had seen hadn't done, and looked at the commitments of traders in VIX futures markets. And when you put all that together, the picture that emerges is that while there is definitely a lot of short volatility bias in the volatility ETP universe right now, it's not at record levels, not right now. It's been at similar levels before. It's been net negative before, meaning that people are net short volatility more than they're long when you just look at all those ETPs. And that's happened in the past. I did a little bit of a back test in the sense of looking at S&P 500 returns 10 days later at any given day. And when you find that these volatility ETPs are that the market is basically net short volatility through them, if this worry was legitimate, then we would expect to find S&P returns, I think, in the future, looking worse than average, when investors are quote, seemingly leaning too far on one side of the boat. But what we found was the exact opposite, that when people are short volatility on a net basis in these products, that the market returns are actually much better than average, usually around 0 to 4% over the next several weeks, which is much better than any time return in the marketplace. And then finally, a lot of people who were worried about this kind of stuff hadn't been noting the fact that short interest, speculative shorts, that is, in the CFTC's weekly commitments of traders report for VIX futures, has decreased dramatically versus the very high levels that it had reached earlier this year. So you've seen people really pulling back on the speculative shorts in VIX futures, people who are classified that way, which excludes, I should mention, the commercial hedgers who would be conceivably ETP issuers who are hedging kind of the natural flow. So they're not even included in the numbers that I'm talking about right now. All of that together presents a picture of, some short exposure in the market, short volatility positioning, but we can't find any evidence of added risk in terms of forward S&P returns as a result of that. The VIX futures data, I think, mitigates a lot of the one-sidedness of that. And finally, I would just mention that from my discussions with investors, including individual investors, people who aren't professional traders, over the years, both when I was at Condor Options before and at Klineman, certainly listener questions on this show, I just have an anecdotal picture of quite a few very, very informed investors. And I don't think that the makeup of the market in 2014 is the same as it was in say 2010 or 2011. I think people have become more educated and more aware of the risks on both sides of long and short volatility positions. So as a result, I don't see any reason to be concerned about that positioning. And so that's why I titled the note "Crying Wolf," like wolf with a V, because everyone's worried about vol, but I think it's a worry that has been run up the flagpole so many times that it's something I don't think deserves real concern at this point.
You're right. There is that temptation on the part of a lot of people. We sometimes do it here ourselves as well to kind of lump all of the VXX, VXY, XIV, TVIX, certainly paper into that kind of crazy fringe of the retail sector. But there's so much volume going up in these. Some days VXX is the number one exchange traded product by volume. Clearly, there is an institutional presence in these as well. There's no way that mom and pop 10 lot could drive these products to the record levels that they are achieving by themselves. So clearly the more sophisticated end of the spectrum has gotten into them for a variety of reasons. Perhaps they're ignorant of the shortcomings of them. Perhaps they're aware of them and trying to exploit them. Either way, they are trading these things to great effect. So I think there's just writing them off or relegating them as that, that's kind of the retail freak show basket, and they're going to react inappropriately when something happens is perhaps a bit of a dated, outmoded perspective on this type of thing. If you want to learn more about this, listeners, Jared has a great write-up on this, and he gets into a lot more detail than we could possibly do here on the show today. Check it out, what they have cooking over there at BGC Partners. Maybe we'll put some summaries for you up on the old Options Insider as well, so you can maybe follow along if you're active in the vol space, but maybe not running a big enough desk to be one of Jared's clients. You, too, can get the benefits of his wisdom, or perhaps dispensing and dismissing of myths here and alarmists nature here in the world of volatility. Speaking of volatility, we'll wrap up here on some of the vol products with, of course, we've mentioned the kind of will they, won't they dance that is VXST. Andrew, we kind of talked about this last week a bit about how this product seems to have got a little bit of life these days. It has over 10,000, 11,000 today, actually, open interest in this product, which is substantial. That's about, almost 10x what we were seeing in the early days of this product. So it clearly is getting some life, getting some interest out there. But it comes in these odd fits and starts that are, just looking at this week, for example. Looking at this week, it started off with a day doing 2,000 contracts a day, and then another 2,000, almost 1,800 the following day, and then 300. And then nearly 3,000, and then 700. So it's just a weird product. It kind of moves in fits and starts. The fact that it is doing so much volume on certain days this week, when the mothership VIX certainly isn't trading that much, and just in general, there isn't a heck of a lot going on. It still is a bit of a mystery as to what is really driving this product, who is using it, what use case they're putting it to. I think it's kind of an open question to see what they're actually using it for. Interestingly enough, the number one hot strike, the number one big position in this product still hasn't changed from last week. These are on the December 3rd cycle of the 20 calls. 3,005 open of those. They were about 3,000 open last week as well. So that's the number one position. Someone specking or hedging to the upside here, and that hasn't gone away. Number two position being on the Nov 26th cycle, the 19 calls, so about 1,000, and the rest of them come down the 15s, the 15 puts, the 17 calls, and the of the 17th cycle, 15 puts as well, all open for about 1,000, and then it kind of drops off a cliff from there. But still, it's interesting to see the number one position unchanged. The use case kind of still relatively similar, though there are some puts starting to sneak into this one as well, which is also a bit unusual. This one was kind of over the top, all calls versus puts. And it's not as bad these days. The open interest is about 3-1, calls versus puts. So there is a bit of a use case coming in these days for people using the put side of the fence as well. We'll see if that continues. Either way, interesting to watch this one. Kind of a bit of a mystery. Andrew, you guys have some active folks in your chat room, some of whom are savvy about all things volatility. Do they have any interest in this? Are they out there trading? Are they part of the 3,000 lots that are going up some days, or is this still kind of a wait and see for them and for you?
We're still trying to figure out the difference between VIX Mo and VIX. No, all kidding aside, I mean, we figured out the difference. It's just, I think they launched kind of a head spinner on that one, but that's a whole other topic. You know what I think? I think the VXST is going to become an interesting product when people think vols really can pop. When VIX is 13, because you've got that pretty extreme, future pressure. As much as VIX Cash is kind of a slave to the contango and backwardation of the future. The short-term stuff more so, like short-term volatility is 28, and the future's trading 20. So that I mean, there will become times when the products become really interesting to trade, real simply. And the lower VIX gets, I think the more interesting VXST gets, because that short-term vol can pop from 13 to 15 so fast. And it makes the product a little, I would say, more interesting as a tradable hedge as we kind of get down here. It's sort of it's an easy, quicker spec because that short-term vol can pop so fast. So I think we're seeing more of it again because vol's getting a little lower. And it's like anything, it takes time for traders, for funds, for anybody to get used to new products. You got to kind of see it move around a little bit. And I think that's where it will get popular, and I think it will actually start trading at some point. And the lower the vol gets, the more interested it becomes as kind of a quick spec because, VIX can move for sure. But, when I did watch how this thing traded, I'm like, oh, wow, that's a big move today. So from those percentage basis gains, those will start bringing traders sort of into the fold, as time goes on, especially like more of the speculators. They will be there.
They will be there. Someone's specking or doing something out here in VXST. I can't really figure out what exactly they're up to yet, but time will tell. We'll see. There's more paper flowing in every day, so at least most days. So we'll see what amasses or emerges there. Meanwhile, we'll move on to the other side of the fence, the less liquid, more opaque side of the fence known as the OTC realm, the variance swaps, vol swaps, all sorts of fun stuff. All right, moving on from the listed vol products into the realm of some of the other products that are hot, exhibiting some vol these days. We talked a lot about crude. Crude still dominating a lot of the conversation this week, still hovering in the mid-70 handle range these days, which is just, I think, crazy for a lot of people who thought that especially when it was in the mid to low 80s, that it was going to kind of taper off, that bearish sentiment had somewhat spent itself in the marketplace. Of course, we weren't seeing that confirmed in the options. The options were telling us a different story. The options, and particularly the volatility skew, was telling us there was a lot of concern, a lot of hedging, a lot of speculative activity to the downside, really driving those crude vols in the put wing through the roof. And we're still seeing that to a degree this week as well. People are still bidding up these puts, depending on where you're looking on the at-the-money implieds. Those options are hovering on the crude, the American crude, of course, right around the 30 level. You start getting into those puts on the downside. They get into the mid-30s and beyond really quickly from an implied volatility level. Some of them even flirting with the 40 handle at some point. So there is definitely some juice still there to the downside. Of course, a little bit of inflection to the upside we'll see if that plays out as well. But still, crude skew still looking relatively meaty. Still, there's some concern, even though we're hovering in the mid-70s now. Still, clearly, some more concern to the downside. Even though a lot of people thinking OPEC may have drawn a line, they're going to support there at 70. You think you would see that kind of come off more south of the 70 handle. Yet we haven't seen it as much as you might expect. Mr. Jared, we'll start with you. What's your take here on what's cooking out there in the commodity land, particularly crude?
Yeah, this is the asset class that just will not stop being interesting. You've got oil finding a little bit of support, I think, over the last week, but people still seem to really hate energy stocks. There was a big trade that went up in ConocoPhillips today in the morning. Someone buying a big put spread, looking for more downside, and I've read about and heard about some people putting on XLE versus USO trades where they are willing to look for flat or higher oil, but think that the risk for energy stocks is going to remain to the downside. And so this is definitely the surprise story of the year, I think, for a lot of people. The question now is whether demand is going to start to kick in to support oil prices. And, of course, there's an OPEC meeting coming up that everyone in the world is watching, although I think the expectations there are pretty low for any dramatic change. But in volatility terms, you've still got oil options are one of the most expensive things in the world in relative terms right now. And, I think we said this last time, but until the fundamental picture gets a little bit clearer, it's certainly understandable why investors are pricing in the high risk premiums that they are.
Yeah, we're looking here while you're talking on this put spread that went up in ConocoPhillips this morning. It looks like it was a bit of a roll. It was about 14,000 of the D70 65 put spread going up against about 12,000 open on the 70 strike. So it looks like he's taking out his opportunity to roll on down. Again, probably taking some profits off the table, but also signaling that perhaps he, like many other people out there in the options, expects continued downside in the near term here for crude, which is interesting in and of itself. Mr. Andrew, I'd imagine crude has to be taking up some time these days over there in the pit land, and people asking, hey, what can we do out here? What's going on here? You guys obviously looking at it from more of the ETF side of the fence, but we won't look askance at you for coming at it from that way, sir. So what's catching your eye out there in crude these days?
Both the energy, the drillers, all that. I think it's kind of a fire sale for all those companies. I think it's easier to approach it from just kind of like the short put side. I've been looking at like the XO, the OIH and stuff like that, just whacking some puts out in that thing. Mostly because I have a little room. But as far as oil goes, I thought last week, maybe I was wrong, that OPEC said we're gonna intervene at 70, which to me was like a giant target at 70 for oil to get driven there. And we got down to around $74 or something like that for the spot price. Didn't quite get to 70, and it seems to have bounced around a little. Maybe now because Japan is going to lower rates, maybe there's a little more economic boost there. They higher demand for oil and all the products like coal's catching a little bit, things like that right now. But there's still, I think, some substantial worry about oil, and the same thing I thought about last week. The slide for the price of oil from about 110 a barrel to 75 has been remarkably quiet. Like, why? Now, we all know supply and demand, but all of a sudden, there's a whole lot more supply on the market, and it kind of quietly got there, which is and usually when there's sliding prices like that, I remember when we had some price crashes before we had it in the 80s, and we had it in the 90s because just, OPEC, everybody just kind of, the price ratchets down a little bit, so they produce a little more, and the price ratchets down a little more, and they produce a little more, and it kind of sneakily gets oversupplied, essentially. And now the U.S., the U.S. is producing at pretty much full crank. They don't care about OPEC, so they're going to keep producing as long as it's profitable, and that is basically a new major player in the cycle, and I don't think we've seen really where oil can go. A lot of domestic industries have already switched to natural gas that can use it because it's so cheap and there's a ton of it. And it seems like it's going to never end at this point. So where can oil go? I don't know. And I think the reason for the put protection is expensive, or more expensive, actually, I should say, in oil as it is for, buying a put on the SPX. So when you think about it, Jared probably did his little study on this, but it looks like oil protection is even more expensive. And supposedly there's not a lot of it. There's equity in spades around for everybody. But I thought whatever the shortage of oil is not happening at least this week or next week. So that expensive premium, actually means there's some real worry that oil can go lower. And it would not surprise me if it did. Let's just put it that way. It would be no real great surprise if it just, fell off the face of the map and broke to some new level, because nobody's given us the reason why it's gotten here in the first place. So generally I do follow the pricing, and when volatility prices downside, in a very heavy way, that's a lot of worried hedging right there, or pure speculation. And we'll see if it plays out. But like I said, it wouldn't surprise me if it did.
Indeed. All right, listeners, now it's time for you guys to take your rightful place here, your rightful seat on the old panel. Time to check on in with the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the Volatility Voicemail. Like the man said, this is the portion of the show where you guys get to take the reins and fire off your questions. Your first one comes in here from a listener who goes by the handle IndyJoe. He writes, saw Mark's tweet about buying high VIX, selling low VIX this week. Can you clarify what he meant by that? Seems counterintuitive. A lot of people responded to this. It's kind of funny. I was chatting with a number of different people at the Global Derivatives event. That's where this tweet kind of came out of. And I was actually chatting with Ewan Sinclair, who's been on our show many times in the past. And we were discussing the different levels of risk premium in the marketplace, as you are wont to do at a conference like this. And in particular, how when the VIX gets really low, that disparity between the risk premium in the marketplace, of course, the level of implied volatility, which is the VIX, versus what the actual realized volatility is typically at more attractive levels, particularly on a percentage terms when you're thinking of it that way, versus when the VIX is really high. And you remember, as we saw last month, when the VIX gapped up into the high 20s, mid to high 20s into the low 30s, realized vol ticked up as well into the 20 or so range. So the disparity there was not as high. So we were talking about how you're much better off probably selling that implied volatility, capturing that risk premium when the VIX is low, and actually turning around and buying it when it's high, because when the realized vol is high, you have a much higher probability of the VIX doing one of its vaunted upside crashes and continuing to break through strikes. And that's the period where you might be attracted to sell it, but actually you might do well over the long term to actually buy at those types of levels. So it was interesting, a thought, and he went up and mentioned it again on a panel after we had just discussed it. So I thought I'll tweet that out about what we're talking about here. And a lot of people wrote back in saying that's completely counterintuitive. But actually, when you think about it, this is exactly the type of thing we've talked about on this show many times, particularly earlier this year, a few months ago, when the VIX was languishing in that 12 to 14 range, as it is again right now. And a lot of the broad financial media was beating that drum, saying VIX is too low, VIX is too low, VIX has to revert back to its quote-unquote long-term mean of 20. And we kept saying on the show, no, realized vol is a 5, realized vol is a 6. There still is a substantial differential, double, if not more, of implied vol in the marketplace versus realized vol. You probably still want to sell this. And so that's exactly what we were talking about there. A lot of people seem to perhaps not respond well. I don't know what the term is. It was interesting, but a lot of people didn't really understand, I think, what we were talking about. But it's still an interesting point. Andrew, it's something we talked about a lot here on this show. I'm sure you can probably weigh in on that as well.
Oh, well, I think the big differentiation is, when we talk about implied volatility or volatility in general, like what kind of vol are we talking about? I was just said earlier, I love Don's, his rant, not his rant, but his, most of the financial media does not understand volatility at all. And to be frank, a lot of the bulge bracket houses don't understand it either, or they all wouldn't have blown out during the crash in 2008. The reality is it's really how realized volatility affects pricing and how underlying movement generates pricing. And when implied volatility is very high, what that usually means is realized volatility is pretty high. And, depending on the type of strategy you want to employ, you've got to be careful, because it's the difference between, do you want to sell the gamma, which is the movement or convexity, I guess, of the position, or do you actually want to sell the vega part? You have to actually separate the two. And you'll become a better trader or a better market participant when you can learn to do that. So, I think what caused a lot of the crash of 2008 was there was basically too much selling of what we'll just call that downside out of the money gamma. That wasn't worth a lot, and it became worth a whole lot. And, when volatility all of a sudden is very expensive, it depends again where you sell it. If you sell it at the money, it cannot be priced expensive enough. If you sell it out of the money, you might have a shot. So again, you have to control the gamma of the position. And I think what the point is when vol's high, you want to own gamma because the market's moving. And when volatility or when realized volatility is really low, you generally want to sell gamma. to try to generate the money. So it's what it is. It's I think there's a lot of let's just call it flying nomenclature all over the place. I know Jared is a good wordsmith. He could probably talk to this better than I can, but I know that's the general problem. People usually are buying and selling the wrong part of the volatility market when it's moving or essentially when it's not moving. And I think the more educated people become on how positions actually work when volatility is blowing up, the better shot they've got at being able to navigate through the market. As far as I can tell from the size of option pits business and the kind of things we do, I'm going to say that 99% of the people have no clue actually how that works. Yet they are market participants every day. So, all I got to say is that's going to give somebody like Jared probably job security for life as he writes papers and explains how volatility works. Of course, people still have to pick it up and read it to understand what the heck's going on. And that's where we find ourselves.
All right, we got time for one more here. This one comes from Pat Cummins. He writes, my question is for Volatility Views. I think the pounding the VIX has taken lately is overdone. Bullish volatility in the long term. Question, what is the best way for me to express that view? You've already dissuaded me from buying VXX, as that is clearly the road to ruin. Well, this Pat here is obviously a longtime listener of the show. I'm glad we could at least dissuade you from that, Pat. He goes on to write, would I be better off buying and holding a 1-year VIX future or a VIX option on a 1-year future? Or is there a third option that I am overlooking? Sincerely, Pat. Well, this is a great question, Pat. We've touched on this in many different aspects, in many different ways on the show in the past, but this kind of is the eternal question that we get quite a bit from people here on this, is exactly the type of thing you're talking about in terms of where do you want to hedge, where do you want to buy? He doesn't mention here, and something that I think would be an interesting option for him as well, and that kind of gets into our next question as well with the puts, is he doesn't mention any sort of direct source of volatility, which would be a SPY or an SPX type product, which will get you all of that stuff Andrew just talked about, all of your Gamma and all your Vega, as well as the nice volatility component you want here as well. So he doesn't mention that. I would certainly throw that into the mix as well. But Jared, I know you're probably champing at the bit to get in on this one. So I've been talking for a while. I'll toss it over to you, sir. What's your take here for our friend, Mr. Cummins?
Yeah, in that mix, I think of the ones that he listed there, if it was limited to those, gosh, I'd have to choose maybe the futures, I guess. But I think it's important to keep in mind that the cost of carry is high, and hedge. I think you can save yourself a lot of money and a lot of effort by making your outlook as precise as possible at the outset. There's just such a big difference between I'm worried that, let's say, stock valuations are too high and they're going to correct, over the next year. If someone starts with a view like that, there's some things you can do in plain vanilla asset classes really simply in terms of your asset allocation mix, I think, that can accomplish a goal with that kind of view in mind. But if you have a specific risk scenario or some kind of a real specific catalyst that you can anchor to, and then hedge in that time frame or hedge that particular area, maybe with a spread that focuses in on the expected downside, it just blows your mind when you do these studies of how much less expensive hedges can be when you get as precise as possible before putting something on. So I certainly wouldn't recommend anything in particular to anybody, but for in the context of the show. But given that the things he selected, by the way, there's no options on 1-year VIX futures. They listed options on VIX futures for a little while, which I thought was a perfectly fine product, but didn't really take off. But you can buy, you could buy 1 year, or you could, buy the longest VIX option. You can trade anything you want OTC, by the way, and you can put on something like that. But as I said before, I think the cost to do that is going to be prohibitively high, especially if it's just a kind of generic hedge against long volatility. Even something as simple as letting a moving average get you in and out of a hedge, or any kind of trigger like that can really reduce your costs. And I think that selecting what kind of option or what kind of options-based instrument to use is actually secondary to getting specific about whatever outlook it is that causes you to want to hedge in the first place.
Andrew, I know you want to dive into this one as well, but it ties so nicely in with the next question. I think I'll just toss that one into the mix. We can get a record 3 questions in this week on the old voicemail box before we have to roll on. But this question comes from listener, goes by the handle Allegory. They write, which is more overpriced, VIX calls or SPX puts? And the reason I say that ties in so nicely because my first thought to that other question, like yours, Andrew, was that, hey, he's omitting the entire direct portion of the spectrum, which is buying that SPX put, getting all that downside protection as well as getting the volatility and everything else. Of course, that brings up the specter of skew, which is exactly what our friend Mr. or Mrs. Allegory is asking. So, Mr. Rock Lobster, where do you fall on this eternal debate, SPX puts versus VIX calls, as well as which one is more overpriced?
I guess as a percentage of at the money, Jerry would have to know, probably has the exact number, but they're kind of around the same, right? You have like a 10 delta put is about 150%, give or take, of at the money. And I'm thinking of VIX at the money volatility, and then where the upside was around 140. So they can go around 200% of at the money, I think, depending on how deep the skew is. So Jerry would know exactly. Probably the VIX is a little bit more expensive than the SPX, I would guess. I haven't actually sit down and measured it out. I've never thought of it. That's not the kind of vol trading I do, but I think overall, in general, I think the SPX puts are a better purchase, and the reason why is because you get gamma and vega. With VIX calls, you are definitely, you're already paying a lot of money for them. You do get that upside bump. They could, if vol explodes huge, a VIX call can do very well, but so can an SPX put. But you do get, your VIX is just a straight bet on where volatility is going, and the SPX you get a little bit of there's gamma in both the options, obviously, because you're long both the options, but I think you do a little better buying SPX puts than you do VIX calls from an expense point of view. But Jerry would probably do a better job answering that question, because I really am not a VIX call buyer except on very short duration. Which gets back to the question. I like buying VIX options when the futures are generally backward. And, to me, that usually means vol is going up. Like flies are cheap, and there's a lot of interesting things to do in VIX when vol futures get super cheap relative to where the cash is, because, mostly that's the market is starting to basically have stress. And usually vol goes up faster when the market's under some stress. So, overall, I would say the VIX puts are cheaper, but I'm sure there is a empirical answer to that question. But the second part that Jared said is understanding duration if you're going to trade options is important. If you do not have a duration for your trade idea, then you have no trade idea. All you have is an opinion that you're taking an open-ended opinion against an option contract that has a finite lifespan, which is probably the road to ruin trading options. So unless you really have a duration in mind when you think vol might jump, it makes it very difficult to trade it. Now, there are ways to have a more open-ended approach. Let's say you want to sell TLT put spreads against maybe a long VIX call or long SPX puts. That's a possibility. You can think of trades like that where one side generates theta, the other side doesn't. So one's theta negative, one's theta positive. And as long as you control the risk on one side, if vol blows up, it should work out okay. So you can structure things like that if you think about it a little bit, which is what we do at Option Pit. But, those are the answers I have to those questions right now.
Jared, anything you want to add on the relative skew of those two products?
Yeah, I think we talked about this a couple months back. If I recall correctly, I think we did a really fantastic job of it. And I don't remember exactly who was on what side, but I just know that was a good discussion that sparked some, I think, follow-up listener questions. So people may want to check out the archives if someone enterprising is able to dig up whatever episode I'm referencing. What I probably said back then is what I'll just say now, which is that, the first half of what Andrew just said, I think, is spot on, especially where the best trade for a given situation depends so much on the details of what you're trying to hedge, whether you're looking for for a hedge against adverse price movement or higher vol as two distinct things. In a very, very broad general sense, my understanding is that VIX options tend to be a bit more overpriced than SPX options are overpriced in a systematic sense. So if you were to sell straddle, hedge, delta hedge to sort of get realized vol, the difference between those two P&Ls is, on my estimation, larger in VIX options than it is in S&P options. And that's why we published a strategy looking at trading that early this year. But that doesn't mean everyone should try to hedge just using VIX options or vice versa. I think that it really depends a lot on your time frame and the details of your outlook and what you're trying to accomplish, which isn't maybe a satisfying answer as always do this one thing, but it's the answer that helps keep costs down, and that's what's most important.
All right, everybody. Unfortunately, we ran a little bit long, but I'll always err on the side of giving you guys, the listeners, a little bit more love rather than diving into the prognostication, particularly going into a holiday week where there isn't really a heck of a lot of vol to be anticipated going forward into the Thanksgiving Day holiday here in the States. But before we go, as always, let me check in with each of my cohorts here to see what they have cooking that may interest you. Starting off with you, Mr. Andrew, what is coming down the pike over there in the land of Option Pit?
Well, we have our boot camp. So exactly this subject matter, although we do not deal with the vol products in boot camp because that's kind of a topic unto itself. But if you want to understand Gamma Vega and how all that stuff interrelates and how it's going to help you manage positions, for a very, very reasonable price, like less than $200, you get 8 hours of instruction. And I'm sure it'll probably save you $200 doing something goofy in the option market. So that starts December 10th, I believe, and it's a 3-day course. So surf on over to optionpit.com/events, and we will be happy to talk to you.
And Mr. Jared, in addition to Crying Wolf, what else are you working on over there at BGC Partners?
I'm right now working on our 2015 outlook for equity derivatives and volatility, looking not just at equities but commodities and rates and some other products for a sense of what to expect in the year ahead. And that's probably going to come out certainly not before December 1st. I've done my version of trying to keep the holidays contained to a reasonable amount of time, and my contribution is to keep outlook research contained within the month of December. So that's my effort there this year.
All right. Thank you for that, sir. And on behalf of Jared and Andrew and, of course, myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. Of course, for sending in such great questions. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. Or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.